This is a Momentum Media production.
The SMSF Advisor Show. Your expert insights into the biggest themes shaping the SMSF advice industry.
Hi everyone, and welcome to the SMSF Advisor Show, and thanks for joining us for part 2 of our SMSF Association Conference wrap. So we're speaking to another 3 great presenters today. Hopefully you might have heard part 1 where we spoke to Joe and Tim from class. We also spoke with Peter Burgess, CEO of the SMSF Association, and we spoke to Shelley Banton from ASF Audits as well. So for today, we've got another 3 interviews with presenters from the conference. We'll be speaking with Simon Kuestenmacher about some of the demographic trends that might impact the SMSF sector. We're speaking to Nicholas Ali from SuperConcepts and Meg Heffron from Heffron as well. We hope you enjoyed part 1 and hope you enjoy listening to some of the useful insights that these speakers have as well.
So we're now joined by Simon Kuestenmacher, and he is one of our keynote speakers at the SMSF Association Conference, talking about the demographics, challenges and opportunities. So this is a really topical area, given that we've seen recently the quality of advice review and the issues of affordability of advice and a whole range of resourcing challenges that sit within the industry. And these, I guess, are going to be front and center of some of the things you're talking about in your session?
Oh, absolutely. And overall, this is a very positive message to talk about here, because the demand for financial advice is only going one way, and that is up.
Yep.
You have the main cohorts that are seeking financial advice, 55 plus, growing at very, very steep rates. So that's wonderful. That means a major challenge for the industry is to actually service all of this demand that comes your way. Mm-hmm. And that's a challenge in its own right. That means the industry should very much embrace AI as a technology, innovation, because these things aren't your enemy. Mm-hmm. These things allow any individual advisor to be more productive, to churn through more clients. And if you think about the role of innovations like AI, they will not kill jobs. Mm-hmm. They will simplify certain tasks. That means that any given advisor is by the end of the day is left with a bigger share of their day doing interpersonal tasks, mm-hmm. rather than mechanical calculating or organizing tasks. And that will ultimately benefit the advisor, because this is ultimately a personal business as well. It will definitely improve the quality of advice, and the customers should be happy as well, because they get more one-on-one time with their clients, with their advisors.
You're going to be speaking about the growth in the older demographic, the 85 plus. With those sorts of trends, is there certain areas of specialization that you think advisors should be looking at with those kind of demographic trends?
So when we're looking at the 85 plus cohort, which is going to double in just 13 years, so other industries have a couple of issues in terms of how do you provide actually physical care to those people. That is not your area of concern. You're concerned about providing decent financial advice and to ensure financial risks are not actually being fallen into. I'm thinking particularly about fraud, about scamming. If I was to pick one major growth industry, it would be scamming rich, aging populations. Yep. That is going to be a very, very lucrative business, to be honest. So that means as advisors, you need to have terribly awkward conversations with your clients, probably as early as their 70s or thereabouts, where you are still, where you've not seen mental decline just yet. Mm. You want to have strategies in place. What do we do? How much do you trust your own judgment as you get older? Mm-hmm. We know that as soon as you're in your 60s, severe mental decline kicks in year by year. So it's an awkward conversation to have, and I would hate to need to have this with my clients sooner or later, but that is part of providing good advice, is to actually navigating your clients through their retirement journey.
And I guess that then includes bringing in other family members, because I know you've made that reference, which is staggering, the volume of people that will reach 85. We've seen that, I guess, statistically within self-managed super funds, where within 5 years it's gone from somewhere around 3 or 4% of members over the age of 70 to now around 28. And that whole issue of cognitive decline and the ability to run your own money is a massive issue given the pot of wealth that sits inside superannuation. And therefore, getting the right people on the bus as people get older is absolutely crucial to ensure that the outcomes that they want to occur and that you protect as much as possible against the potential concerns that you raise.
That's exactly what you want to be doing. That's part of the awkward discussions that you need to have with your clients, is to make sure that you bring their kids on board, which, by the way, is a fantastic business strategy to begin with, is to actually have your baby boomer clients constantly invite their millennial kids into meetings. They don't need to be formally on board or anything. Just make sure that they know who you are, that they start trusting you, because ultimately that is the easiest way of growing a client base. Plus, by onboarding millennials now through their parents, essentially, you would get a younger cohort into your business than you currently are. So that's a no-brainer, I would say, in this kind of approach. Plus, it does provide the best quality of service, because you want to ensure that the intergenerational wealth transfer occurs smoothly. So it means you need to bring the whole family on board early on. You need to put things in place. These things need to be regularly updated. And you want to make sure that you have things, safeguards in place where you say, how long is mom, is dad allowed to trust themselves? I would not enjoy this conversation with my own parents, but it is something, if you want to protect the wealth, if you want to ensure that you have the best financial outcomes, that awkward discussion is a must.
And I think you have to protect yourself in the risk that you don't address those things that could end up in a litigation claim potentially about you and the role that you've had, because I talk to industry professionals and lawyers and stuff, and they talk about the fact that you've been collecting money off these clients for years and years and years, and if you don't identify these things and help to address and manage these risks, it might just be that you've documented those conversations. You potentially leave yourself exposed.
I guess that's certainly a case. Of course, you need to look after your own safety as an advisor as well. Plus, in a sense, many of those challenges that you will be facing with each and every client are utterly predictable, because we know what kind of peaks you go through in your life. So we know when your mental decline begins. We know when your physical decline begins. All of this is to a certain degree predictable. So take those into account. We even know the ups and downs of the standard retirement journey, meaning you can guide your clients through retirement from more than just the financial angle. You know the ups and downs. You know that after a couple of years of retirement, when the initial joint excitement of retirement has slowed down, that's when suicides go up. That's when divorces go up. Lots and lots of terrible stuff happens in these years. And if you know those and you can kind of point your clients towards these risks, you can help them in a very, very significant way. Yes, you are not a counselor, you're a financial advisor, but increasingly, I'd say, managing the retirement journey in a holistic way becomes a great offering. Plus, if you listen to my demographic spiel, you will know about the shortage in aged care workers. And if you are in your 70s today, and you're just assuming that in 10 years' time you will get the care that you think you need or that you will need, think again, it will be an uphill battle. The richer you are, the easier it is because you can throw money at the problem. But the average retiree probably at the moment has no idea how hard it will be to find the service that they expect in old age.
Well, that's been hugely insightful, so thank you. The audience here, I think, is going to get fantastic value, not only those attending your session at the conference, but from the audience listening to the SMSF Advisor Show. So from Miranda and myself, thanks for being a part of it.
It's been good fun.
Excellent. Thank you. So now joined by Nicholas Ali, who spoke at the conference here on LRBA's Avoiding the Sting. Welcome.
Thanks, Aaron. Thanks for having me.
So what we want to do with this is just get a bit of an insight from what you spoke about, and I guess most importantly, some of the common themes that we're seeing in the LRBA space at the moment.
Yeah, so it's a bit of a back to basics session and looking at making sure you get the documentation right and establish your procedures right, because as you know, it's a bit hard to retro-engineer these things.
Yes.
So that's mainly what I spoke about.
Yep. So one of the things I think that's going to become quite interesting over the next few months, and I think Peter Burgess spoke about it in his session, is this Council of Financial Regulators report.
Yes.
So we talk about leverage in super, not having any systemic risks, but Peter raised it, and we can see it quite clearly in there. There is some individual risk, I guess. So what are some of the things that we might need to be contemplating, around some of the commentary there? Have you got any sort of views and opinions on that yourself?
Yeah, being an administrator of self-managed superannuation funds, we come across a lot of limited recourse borrowing arrangements. The majority of them are related party loans, and the vast majority of those are very well done. Yep. So we see very, very low levels of incorrectness. Is it?
Yep.
Incorrectness. Yep. Trustees are very, very good with regard to setting up their limited recourse borrowing arrangements. Obviously, people with self-managed superannuation funds, it's their money, so they take it very, very seriously. I don't see this systemic risk. I don't see this even on an individual level with regard to people setting up their related party LRBAs. Even if there is some form of concentration risk for the particular fund, it might be because they know they're going to have a contribution at a later point in time. It might be because they know that particular asset, that lumpy asset that they bought, is going to increase massively in value. They might specialise in property. They might be a property developer. So, yeah, I sort of get the point, but I think these institutions, this is going to sound a bit disingenuous, but I think they feel that SMF trustees are not stupid, but aren't responsible with their own money. And that's the thing. People are. People are very responsible with their own money. And obviously they're more engaged than an APRA fund member. So they do take their obligations seriously, and they do set these things up to be successful because it's obviously their retirement savings. So, yeah, I don't think maybe at the margin we've got issues. But look, I was
just going to say there, because I think you're right. You raise a really interesting and valid point there in the margins. I mean, we've gone through a process of provision of advice, ASIC really coming out with a fairly heavy hand on unscrupulous one-stop shops and those sorts of things. And it's kind of that area where it really has never had a good flow and a good go, right? So by and large, we do see structured correctly, well-resourced and working as expected, but it gets sort of scrutinised by these pockets out there of one-stop shops and small balances, and actually don't contemplate the broader asset allocation of the individual. Whilst we might have asset concentration in the fund,
that's a really good point. Yeah.
More broadly, actually, when you think about the rest of there, it doesn't look anywhere near as bad as what it is. So
yeah, that's a really good point. When you look at the members' whole of wealth wallet, the people that enter into limited recourse borrowing arrangements, they tend to be at the higher end of the SMSF market. So they tend to have higher account balances. They tend to be older trustees, more experienced trustees. So yeah, if you looked at the fund in isolation, that fund does have a concentration risk, or it might be more than. What was it? The ATO said 17,000 funds had more than 90% in one asset class. But if you take that broader view, then I agree. It's probably on a macro level a diversified client, if you want to look at it that way. And also the criteria people have to go through, not so much with related party loans, but with the commercial loan. I think what's his name, Latrobe and Liberty. Yep, they're not going to let idiots through. In fact, the only real, in inverted commas, client issues that I see with LRBAs is ASIC shadow shoppers, where you'll get somebody, it's always in the same font, Times New Roman, it's always from a Hotmail account, and it's like, oh yeah, hi, we've got $10,000 in super and we want to borrow and put it all into one asset. What do you think? Yeah. You think, ASIC. It's a bad idea. So I don't think in the last sort of, since Safe Harbour's come in, I haven't seen anything that would be a dodgy related party loan. That's not to say that they're not out there.
Yep.
And I think it's not so much a case of trustees set out to get it wrong. I think, like you said, there's brokers, there's people at the margin that might deceive trustees.
Yeah, I couldn't agree more in that respect. So anything else you want to add around the session, I guess, that you covered off that'd be available for audience?
I tell you what, it's the first time in 3 years that I've worn shoes. So, actually, it's the first time in 3 years that I've worn pants as well.
Yeah.
So standing up it's difficult.
Yeah, it's conference out. Like this is like yesterday was a pretty solid day. So to actually keep the attention span for that long is a big enough challenge. And I think that's the biggest challenge getting back into conference mode.
Yeah, but it's great to be face-to-face again.
Yeah.
And you know this, I've met you many, many times and spoken to you, Miranda. This is a really small industry.
Yeah.
Notwithstanding that it's got, $900 billion in member assets. SMSF administration, SMSF advice, training is a very, very close industry. We all work together, so it's great seeing colleagues that you haven't seen for a long period of time. It's great catching up with staff, other staff members that you haven't seen for a long period of time. So getting back into that routine after the pandemic hiatus feels good.
Yeah,
really, really
absolutely,
good.
absolutely. All right, well, thank you. It's great to catch up.
Good to see you again.
Thank you again, and no doubt we'll be talking to you at some stage on the SMSF Advisor Show throughout the year.
Yeah, good to speak to you, Aaron.
Thank you.
See you, mate.
So we're now joined by Meg Heffron, CEO of Heffron. Welcome.
Thanks very much, Aaron.
Happy conference.
It is, isn't it?
It's fantastic. Like, it's just great. I mean, last year we kind of got back face-to-face, but there was that little bit of hesitation, nervousness and stuff about it. For this, like, everyone's just kind of all in again, isn't it?
This does feel a bit like the old days, doesn't it?
Yeah. And it's that. It must be Melbourne, I reckon, too. So, being a bit biased.
God's own country. Absolutely, yes.
So you obviously spoke at the plenary this morning. Bit of insight, what you're covering, and I guess what you see as some key focus areas for the year.
Well, I only talked about 4 things, so that's gave myself an easy ride there. So the first one I talked about, which what isn't even really an SMSF issue, but I think actually lots of SMSF clients do or should care about it, was the big increases we saw in the income test thresholds for the Commonwealth Seniors Health Card, and how all of a sudden that brings a whole bunch of even quite wealthy seniors into the net for possibly getting the Commonwealth Seniors Health Card. And I think the thing that often takes people by surprise that I wanted to emphasise was not only have the income test thresholds increased, so now you can have a lot more income and still get the card, but even without that, I think people often forget that income, when it comes to super for this purpose, is just a deeming amount on their pension only. I think I got a lot of questions after the session saying, hang on, what about the accumulation account? And sort of some surprise that accumulation accounts are effectively hidden for the purposes of that test.
Yep.
So, I think we'll find a lot of our clients that we might not have thought about the card for before, all of a sudden we will be.
Yeah, and I think you're right. And there's a whole cohort that we've kind of left in, I want to say the wilderness, but that equally applies with the contributions and other things, that all of a sudden there's this segment of our client base that we're now starting to reconvene in conversations, and that Commonwealth Seniors Health Card is smack bang in that conversation.
You're right. I actually hadn't really thought about that before, but there's a theme, isn't there, of if we've ever had a set and forget era where you gave contributions advice up to 65, and then it was pensions advice, and then that was it.
Yep.
And you waited till they died and worried about estate planning. But we've had so many changes of rules or new opportunities emerge in the last couple of years that every 10 seconds I feel like I'm saying to someone, that cohort of clients that you thought you dealt with for contributions, actually they're back on the table now, because we don't have to worry about work tests for non-concessional contributions, and all of a sudden we've got higher thresholds they can contribute, and the Commonwealth Seniors Health Card's just like that.
And so we're coming to them with multiple things, really, aren't we? So it's great. So from a strategy point of view, licking your lips.
It gives us all something to talk about. We wouldn't want to get bored.
Yeah. So that's one.
Yes.
What else?
Right. So the other thing, the other thing I talked about was the increase in the transfer balance cap, which will happen from 1 July 2023 up to 1.9 million. And the main thing I was interested in there was I did a little bit of modelling on whether somebody who's thinking of starting a pension today should necessarily wait for that increase to kick in or whether they should start their pension anyway. And as you'd expect, I think I'm channeling Scott Hay-Bartlam here when I say it depends. But as you'd expect, there are a lot of people who shouldn't wait at all if they've had a lot of taxable income in their fund this year. Getting ECPI locked in as quickly as they possibly can makes sense. And there'll be others who should wait until next year, but it's not a lay down misère that you do wait.
You raised a good point with the CGT events happening that might influence.
Do you want me to save you from talking, Miranda, since you're losing your voice? I think what you're going to say is if you've just got steady income, I was using the example of a fund that's about $2 million with one member, could start a $1.7 million pension or could wait, start a $1.9 million pension. And if they just had sort of steady as she goes income, maybe 5% of the portfolio, $100,000 a year, then, maybe it's debatable whether you wait or whether you start. But if they had a big capital gains event at any time during the year, before or after the pension started, then all of a sudden the cost of waiting becomes much, much bigger. Yeah. So maybe don't wait, start the pension now.
So one of the things that you did raise, obviously with your actuarial background, was getting the room excited about ECPI. So can I get you to elaborate a little bit there for our audience?
So do you think I succeeded? Have we walked out with an entire population
anytime
of SMSF professionals?
Anytime you talk, you get the crowd excited, Meg. So you can talk ECPI and you'll get
anytime.
them. You can talk about death. You can talk about contributions. This crowd is pumped for Meg Heffron.
Thank you, Aaron. Well,
came under the table.
So what I was trying to do there was I think there's a whole, as you know, rules changed 1 July 2021. Accountants doing tax returns now for 21-22 have choices to make for some funds about how they calculate ECPI. And I guess the key point I was trying to emphasise in that session was how profoundly the choice can impact the outcome for the client and how it's so where I was, I guess, trying to get people excited was understanding the choice is a really simple way of adding enormous value and how advisors play a huge role there because advisors are often the ones that are driving when assets are sold, which is, capital gains can be a big contributor to ECPI. And they also control when pensions start and when contributions go in. So I do believe my own propaganda there. It's actually well worthwhile understanding a little bit about how ECPI works because you can have such a great impact on your client.
Yeah, so that position, I guess, with those law changes is it kind of goes, well, the decision's made in the tax return. But as you rightly said, this is now sits front and centre at the planning position because you can actually contemplate the timing, whether you want to use it or not from an election point of view.
Yeah.
So I think, you're 100% correct, and I'm excited about it, so you can hear it in my voice, because it does become something that you go, well, there is a default option, but if you've got a particular event, an abnormal gain or a loss, and I think the loss one is probably equally important because what we're going to find is we're going to have a lot of people that will have, in the event of death, an excess transfer balance, so they'll have both accumulation and pension. So you might have a loss that would have otherwise been lost that could be utilised in the future because you're going to have both accumulation and pension interest.
Absolutely. Yeah, really good point. I didn't talk about losses at all this morning, but that's a great example of where it's worth making a choice that lets you hang on to your losses because you're probably going to use them one day.
Yeah.
I think that, there was a time when the typical process was clients went fully to pension phase eventually and stayed there. And when one spouse died, the other inherited their super, often as a pension, and it stayed in pension phase. So by the time even the last person died, all the money was in pension phase. So we weren't thinking about CGT at all. It's almost a certainty that people with large balances these days, the last survivor will die with an accumulation and a pension balance. So CGTs, so anything that protects you from CGT is awesome.
Yeah, absolutely. Well, it's great to catch up with you and for the audience to obviously hear from some of these strategies, and no doubt there's going to be plenty more that we're going to be following and be excited to hear about as we work through 2023. So great to catch up and thanks for joining us.
Yeah, thanks for having me.
Pleasure. So, Miranda, that wraps up what was a fantastic national conference. As I said at the start of part one, I think we had around 1,300 attendees to the conference. So it's back, I think, was one of the things that was a common theme in talking to people. So from a key takeaways point from you, what were some of the things that you enjoyed most out of and really thought it would pique the interest of our audience in the SMSF Advisor Show?
Well, it was interesting to hear from both the two key sort of politicians from both parties in this area and sort of hearing what their plans for superannuation are. I think it gave everyone some valuable insights there.
Yep. I think for me, a couple of other things that were worth noting. I know some of the budget measures that we had seen previously for SMSFs, there was some question marks around how the government was going to proceed with the residency rules. The SMSFA did come out and confirm that both parts of those measures, both the active member test and also the central management and control test, still are both on the table. There was a bit of a question mark as to whether that active member test, because we didn't see it in the budget papers, whether they were still going to proceed with that. So we did get some confirmation via the SMSFA through discussion with Treasury that would continue. And they also got some confirmation on the legacy pension thing. So those two items, I think, where we had some uncertainty as to whether they were still going to proceed or not, they're still on the radar. Quite clearly, they're not priorities of the government at this point in time, but we will hopefully see those measures proceed at some point in the future. So it's great to get this mix of the technical content. You get the update from the association and the engagement that they have, obviously, with parts of government, the participation of government and the regulators. And I know we had representatives there from the ATO and ASIC and the like. So, you just get kind of everything that you need in that 2.5 days worth of content. And so adding keynotes like Simon Kuestenmacher was fascinating to when you hear the trends. It was scary that the number of individuals in Australia that are going to be over the age of 85 is ramping up significantly, and the cost of aged care associated with those is going to be, if you think there's a problem today, the problems in 10 years' time are going to be very scary. And all these things have real application in our client base with our SMSF clients and our clients in general. So keeping up to date with all these things are absolutely crucial. And kudos again to the SMSF Association for putting on what was, again, a brilliant conference.
Yes, it certainly was a great event. And as you said, there was such a big mix of people from different areas, and it really did add a lot of value, I think.
Yeah, absolutely. And next year it goes to Brisbane. So if you haven't attended for a little while or you didn't attend this year, recommend that you look to sign up for the SMSF National Conference in 2023. Well, Miranda, that wraps up our 2-part series for our SMSF Advisor Show. If anyone has any questions, suggestions for topics or speakers, how can they get in contact with us?
So they can get in touch at editor@smsfadvisoronline.com.au.
Well, thank you, everyone, once again for joining us for the SMSF Advisor Show. I hope you have a great rest of the week, and we'll catch you for our next episode in a fortnight's time. Take care and bye for now.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.